Mr. Chairman, ladies and gentlemen, it's a big honor to speak at your event here. Especially it has been quite a while ago since I spoke last time on an event like this. It was in Düsseldorf in September, I think, 2019. And some of you may remember, some of you I remember, some of you may not remember because they have not attended or have forgotten. Whatever. The world was very different in September 2019 than it is today, because we have one pandemic between then and now, which has changed a lot. And preparing for this conference, I scrolled through my old notes from 2019, and the topic I discussed with you was at that time, why is inflation so low? Will it come up ever again? Well, we all know that this is a topic of the past, and inflation has come up quite well, much more than I and most others could imagine back then in 2019. What I have here on this slide for you is inflation rates, core inflation rates, without oil price, without volatile components like food, for the G10 countries. And I've not labeled these lines. They are all gray. I've just put in the median of the G10 as a darker line here, because with one exception, this low line which stayed below 2% was Switzerland, by the way. All others have shown quite a remarkable uprise, and core inflation rates in the median of the G10 countries peaked around 6% year on year. Obviously as a consequence of the pandemic. And how the pandemic influenced inflation rates, this is a long topic, and we can discuss for hours about the reasons. Was it more supply chain disruptions? Was it more a change in the demand of global consumers? Yeah, we all had to stay at home in lockdowns, and therefore at that time consumed very differently than we consumed before. How has consumption normalized afterwards? Are we still consuming less services and more non-durable goods, especially? There were a lot of reasons for that one. But the remarkable thing was that this problem we discussed back in 2019 has vanished, basically. Has not been resolved. I would not like to use the word resolved, but has vanished. And this was the problem of what I called at that time a excess supply of capital, because partly for demographic reasons, we had at that point in 2019 the situation that a lot of baby boomers in the Western economies, in China, were approaching retirement age, and therefore were saving a lot. And this saving could not be lifted up by expansionary monetary policies. And at the same time, obviously, capital demand was not holding up as well, and therefore we had basically a lack of capital demand and an excess of capital supply, which meant not only that inflation rates stayed low, but also that central banks could afford to have also low interest rates. Yeah, and here's the other picture which shows key interest rates of the G10 central banks, and they were all, with very few exceptions, also below 2%, some of them even negative. Therefore, it was not only that inflation was low, which at least for producers might not be such a good story per se, but it was also that central banks could afford to lower interest rates very aggressively and to keep them at very low levels. During the pandemic, everybody was even more aggressive, and we had interest rates at the zero lower bound, but this is not so important. Look at the left-hand side of the chart, where we had low inflation rates even before the interest rates even before the pandemic. Therefore, this was a nice time for everybody who needed capital, because there was a lot of supply of capital, and therefore the price of getting capital was very low. Interest rates were very low. even compared to the low inflation rates. Yeah? So this was a nice time for investing if you had enough demand. This was the other point. This was the not so nice part of the story, and the economists always tell you something, nice stories, but then they come up with not so nice parts. And the not so nice part was obviously a lack of demand because of all the baby boomers who were saving despite the low interest rates and were not inclined to consume very much, and therefore consumption was lackluster at that point in time. But the environment for getting capital was something which was very different. Now we are past that time. We have seen the spike in inflation. We have seen the very low interest rates. Yeah, everything near the possible lower bounds, which was 0% for some countries or negative for Eurozone or Switzerland or Japan. And everywhere else, basically zero in interest rates. This was obviously not sustainable. This was a emergency measure during the pandemic, and once the pandemic was over, everybody was raising interest rates again, but then very aggressively, obviously, because inflation was so high. Yeah? With this high inflation, you have to raise interest rates not only to get inflation down to the target levels of central banks, which are mostly 2%, sometimes a little bit higher, sometimes a little bit lower. But the main point is, if the central banks would not have reacted, we might end up in a situation where inflation is not only high, but further accelerating. And this was obviously something which had to be avoided, because this has no end, basically. There's no equilibrium if a central bank does not react to the interest rates and does not react on high inflation rates with an interest rate policy. And we saw in Turkey that this could even lead up to inflation rates well beyond 60%. So this was something that had to be avoided. And therefore, central banks were raising interest rates very heavily. This was certainly something which put a burden on the real economy. And we saw, as we heard before, global growth has recovered from the lockdowns, but has not recovered very much, and therefore this was something where central banks had to take the burden to raise interest rates to prevent, to bring inflation rates down, and even more importantly, to prevent inflation rates from accelerating further. Now, as you've seen before, inflation rates are coming down again. Mission achieved. Central banks have done what they are expected to do. They brought inflation rates down. Not to target levels yet, but with a strong trend downwards. So everybody was expecting by the end of last year, early this year, that then this would be the situation where central banks could afford to cut interest rates. Mission achieved. The measure can be unwound that that they had to put in place to bring inflation down. Well, the point is, that's not so easy, because we don't know yet if we will end up in this situation of the 2010s, of 2017, 18, 19, and even before. I could have made the chart even longer, where there's a lack of inflation pressure, where there's a excess supply of capital around the globe, or if we would fall back to a situation which I like to compare more with the 1990s, where in normal times, not in recession times, but in normal times, central banks had to be careful not to lower interest rates too much, because otherwise inflation would then come up again, or would at least not return to levels around 2%. Therefore, the difficult question is, once the shock abates, will inflation settle down at levels around 2% or even slightly below 2%, like before 2020, before the pandemic? Or will we, or have we abandoned this low inflation environment of the 2010 years completely with this pandemic episode, with this global inflation shock? And this is something which, as you heard before, this is something where people are getting more concerned at the moment. A lot of people were expecting, well, everything comes back to normal, inflation rates at 2%, interest rates can be cut quite quickly and quite aggressively as they have been before on very low levels. This is a normal thing where we return to once this inflation shock has abated. This is a story which has got much less attraction. Now I have to become, by training I'm a statistician, and therefore excuse me for being a little bit technical now. It is important because the way we look at the data gives us completely different stories. You saw in year-on-year rates that inflation is falling. But what is a year-on-year rate? It's a comparison of current price levels to the price level 12 months ago. And this measure year-on-year, therefore, sums up and averages all the inflation developments that we saw over the last 12 months. But if the inflation picture changes so rapidly, an average over 12 months, sorry, is something which is not very informative. And therefore, what we look as economists look to is more month-on-month inflation rates. This is a lighter line here, the lighter petrol-colored line here. The problem with that is, and why we normally don't show it to the public, I make an exception here, is it's extremely volatile. It's extremely volatile because of measurement errors, because of special factors, because of seasonality. Seasonality you can get rid of. There are good statistical procedures here, and I got rid of seasonality. Nevertheless, this lighter line is extremely volatile, and therefore does not give us a good picture. There's a lot of noise in this month-of-month inflation rates, and this noise is overshadowing the signal of underlying inflation. What I've done here, I've calculated the exponential moving average. Not completely uninteresting what this is, but something like a smoothed version of this lighter line. This is a darker line here, EWMA, exponentially weighted moving average. This for the US inflation. This is a picture for the US inflation. And this line shows to us economists that the downtrend in inflation has stopped. Therefore, don't care so much about the technicalities. What you should remember from this picture is that a helpful measure for the actual dynamics of inflation has stopped falling and is even rising a little bit again. The rise is not so important. The point is it has stopped falling. And this small dotted line here is the level of the month-on-month rate, which would be compatible with the 2% Fed inflation target. The point is, the downtrend has stopped too early. Inflation does not fall anymore in the US and has stopped falling at levels which are not consistent with the Fed's inflation target. We would end up at something like 3 or 4%, 4% actually, inflation levels if inflation would stabilize around the latest levels. 3 or 4% inflation was way too high for the Fed, and therefore the latest data show us mission is not achieved. Mission is partially achieved, but not fully so. And therefore we see in the latest market expectations that this outlook for very quick rate cuts by the Fed has been revised. This I'm showing you here. Again, a little bit of technicalities, sorry about that one, but this is basically the Fed target rate, which is a little bit brighter line, and the effective Fed fund rate, which is a darker line. I show you the effective one because for this one we get market expectations in terms of OES contracts. Forget about them. It's what the market is expecting of the Fed. And these brighter petrol-colored dots are what the market expected by the end of last year. And the darker ones are the ones which the market is expecting right now. The yellow ones are what the Fed has by itself expected. Last time they showed us their own forecast of their own future actions. And you see, obviously, the market is expecting much less rate cuts. Still rate cuts. still believing that the current level is a little bit too high and the Fed has to do some fine adjustment, but not anything near the rate cuts that the market has expected by the end of last year. End of last year, the market expected US interest rates to settle down around 3%. Now it's expecting them to settle down at 4.5%. Quite a big difference. And there are even speculations, even some analysts who are expecting the Fed not to cut at all, and even some extreme views who are expecting the Fed to hike interest rates again. Therefore, this picture of interest rates will come down, inflation will come down, we will fall back to the scenario of the 2010s before the pandemic, of what we saw in 2017, 18, and 19. This scenario is doubtful, at least at the moment, and some say it's unrealistic. It's more realistic that we fall back to a scenario where capital will be a scarce product, and interest rates have to stay high, otherwise we would see an overheating of the economy and not a return of inflation towards anything close to 2%. And again, the point is, we can discuss a lot about should inflation be 2%, should inflation be 3%, should the Fed, should the other central banks adjust their inflation targets. That's not the point. The point is, central banks have to show that they can bring inflation down to the levels they have promised to do. If this is the right level or not, this is something which is of secondary importance. The most important thing is central banks have to show the ability to bring inflation down. Otherwise, inflation will not stay at too high levels, but otherwise inflation will accelerate. And this is the thing they have to avoid. And therefore, it's so important that they bring down inflation not exactly to 2.0%. 2.2, 2.3, 2.4 would be nice, would be close enough, but to something close to 2%, not 4 or 3%. And therefore, that's quite likely that the Fed will not cut as expected last year, but will cut only a little bit. Something between the yellow line and the market expectation, I think, is something which is realistic. 4.5%. This might be the terminal rate after the rate cuts, because I think the market is right in its assumption that will not fall back to the 2010s, but more to the 1990s. This is a normal situation. The 2010s were the crazy period of low interest rates, low inflation, and excess of capital. Normally, capital is scarce. And by the way, if this, my preference of the story that explained why the 2010s were such an extraordinary period, the demographic story, if this is true, if you believe in this story, you have every reason to believe that we will not fall back to the 2010s, but more to the 1990s, because, well, the baby boomers are largely entering retirement age now. This process has been quickened by the pandemic, because the typical baby boomer in the US, in Europe, in many other industrialized countries who left the labor market during the pandemic has not come back. And therefore, this is something where this high saving rates that were generated in the 2010s are missing globally now, at least to a large degree. And this is a story which explains, from my point of view, why we don't have this excess capital supply, this excess savings in the global economy anymore. So, not a good story for those who are sensitive against higher interest rates. But what about growth? If central banks don't cut so much, what's about the growth picture? Here's an interesting story of the last quarters and last couple of years, basically. From my point of view, is the divergence in the growth picture of the US versus the rest of the world. What I show you here is GDP, gross domestic product, but not in the way you normally see it as a year-on-year rate, how quickly does it grow, but in levels. adjusted for seasonal effects, adjusted for prices, real GDP, how many goods and services do these economies produce, US, Eurozone, UK and Japan as the largest advanced economies. China is a different story, we'll talk about China later. The levels. And to make them comparable, I've adjusted the level, I've scaled them so that they are all 100 by late 2019. And here you see obviously the development of the corona pandemic. GDP was falling like a stone due to the lockdowns. Everybody was sitting at home, nobody was producing gross domestic product anymore. And therefore we had this collapse in GDP, which then recovered very quickly when we all came back to our offices, to our factories, and started to produce gross domestic product again. Therefore, this quick recovery, this was not a normal recession. In a recession, it would have stayed at lower levels much, much longer. But we had this quick recovery because it was lockdown and then reopening and everything was coming back to normal. The point is, the most important point at the moment is, the US did not face any long-term consequences of that one. The US GDP is back at pre-corona trends and is growing at a high speed, comparable to the one we saw before corona. And this is only the case in the US. This is not the case in other economies, and here Eurozone, UK and Japan as three examples. They have recovered from this corona lockdown and from the breakdown in GDP quite quickly as well. Not as quickly as US, but they all have recovered. Even Japan is at pre-corona levels meanwhile. But the point is they are not growing anymore. We have zero growth in most larger economies, larger advanced economies, and we have relatively low growth in many emerging markets, by the way, as well. This is not such a big surprise to an economist, by the way, because as you've seen, central banks have raised their interest rates quite aggressively with 50 basis point hikes, one after another, 75 basis points from time to time here and there also. And this is certainly something which cools down economies very much. And therefore, it's not the end of the world for Eurozone, UK, Japan. It's not the end of the growth, and this is not a sign of a stagnation forever, but this is a normal consequence of this super aggressive monetary policy, which normally cools down growth and therefore by this way reduces inflation pressure, something which has worked here in Europe, here in the UK and in Japan. And the US was the exception. And the big point is, why was the US the exception? And I've shown you before that US inflation rates seem to have stopped their downtrend and seem to have stabilized at levels which are too high and might even increase further. We saw higher trend inflation in the US in the last couple of months. Therefore, one theory why the US is performing so well is, well, because everywhere else central banks have done enough in terms of restrictive monetary policy to cool down growth, but also to cool down inflation and to bring inflation to something near the target levels. For the Eurozone, this trend inflation at the moment, for example, is 2.5%. You might say 2.5 still is a little bit too much. It's not exactly 2, but perhaps it's close enough to be at least satisfied with what the ECB did in terms of bringing inflation down, but also in terms of cooling down the Eurozone economy. Is the US growing only so much stronger than the rest of the world because the Fed has not cooled down the US economy enough to bring inflation down? Frankly, I don't have the answer. I don't know, because this is such an unusual period that it's hardly comparable to anything we saw before in the post-war history of the economics of industrialized economies. Therefore, we don't have, as economists, a clue of how to compare to anything we've seen before. And therefore, all the answers you hear are highly uncertain. I'm old enough to admit that I don't know, but a lot of economists tend to tell you they know exactly what's happening. That's not true. This is a situation which is so unprecedented that it's hardly possible to say something definite about it. And therefore, a lot of arguments speak to for the interpretation of, the Fed has not been aggressive enough. They should have hiked interest rates even more to bring inflation down, and then, by the consequence, US growth would have not been so spectacular as it was over the last couple of years and quarters. This is the easiest interpretation of this one. This is the most obvious interpretation for an economist looking at this situation. And therefore, I fully understand, I cannot say anything against this kind of interpretation. But what I want to show you is that this interpretation that you hear quite often in the market, that the Fed will have to stay more restrictive, and this will bring down US growth rates and will normalize US growth compared to what we see in the rest of the world. This interpretation is not the only one which is possible, and not the only valid interpretation. And to show you this one, I'll show you a longer chart, starting in 1980. And what I show you here is per capita GDP. Obviously, the US partly is growing quicker than Europe, UK, and Japan, because US working age population is growing faster than in Eurozone, UK, and Japan, largely because of immigration. The three lower ones have more restrictive immigration policies, and therefore the US population is growing stronger. I want to correct for this one. We don't know how this will develop in the future. We don't know who will win presidential election on 5th of November in the US, and we don't know how the immigration policy of the US will be at that point in time. I wanted to correct for this one, and therefore we'll show you in the next chart per capita GDP, regardless of the size of the population that is producing that GDP. And I'll show it to you in percent of US GDP, to show the difference of the rest of the world to the US. And therefore the US always obviously is at 100. The US always has 100% of US GDP. No wonder. The other ones I show you here on two charts, Germany, France, and Italy on the left-hand side, UK and Japan on the right-hand side. And what you see is Germany is a little bit exception. Leave out Germany for a while. For example, if you look at France and Italy, they have a growth disadvantage compared to the US basically since the chart starts, since the 1980s. Their per capita GDP was around 88% in 1980 and is around 75 or 68% right now. They always had a growth disadvantage to the US in the last 45 years. And the same holds true for Japan since the 1990s, since the bubble economy of the 1980s exploded, where they had a per capita GDP of 90% of the US, they have fallen to 65. UK stayed relatively constant as long as they remained in the European Union. Once they decided to leave it, we saw a drop. Let's see what's happening there. And Germany is a little bit of a exception because between 2000 and 2014-15 or so, it saw a large increase in the per capita GDP. But Germany is an exception because I think Germany profited exceptionally, to an exceptional degree, from the globalization trend and from China's growth story of that time. As we have heard, China's growth story basically is over, and therefore Germany is joining the rest of the pack since then. So we always saw a growth advantage of the US. What we saw in the chart before is not something which is exceptionally new. This is something which is a normal case since the 1980s. And therefore, we must at least have the scenario, or the deal with this possible scenario that this US growth advantage is something which is permanent. Not to the extent we are seeing at the moment, surely. If the Fed keeps rates higher for longer, this will have a negative effect. If the ECB, if the Bank of England start cutting interest rates, if the Bank of Japan does not hike interest rates to a significant degree, this might help their economies from this stagnation phase. But a large chunk of that one might be permanent. This is what these pictures, I think, show you. And therefore, all who are saying this is only because the Fed did not do enough and they will have to do more and therefore everything will normalize and everything will equalize, yeah, maybe, but there are arguments also against this view. Now coming back to this story of is capital scarce or is capital there in oversupply. What I show you here is long-term yields of government bonds for the US and for the Eurozone. For the US UST bonds, for the Eurozone German Bunds as the benchmark bond here. Therefore, something which is as risk-free as possible in the US and in the Eurozone. And I show you real yields adjusted for inflation expectations, because obviously when you expect inflation to be high, you also demand a high yield on a bond, because otherwise inflation eats up all of your returns, and therefore high inflation is something which is driving up bond yields. So therefore what I did here was I deducted inflation expectations from government bond yields and ended up with this one, 5-year, which is a long-term measure. So for what the market expects for the long run, not regarding the current cyclical situation, but for the long run. Why did I do it? Because in the past this was always the same in Europe and in the US. You see the US line and the T-notes line and the German Bunds line, they were more or less the same. And I remember very well that we wrote hundreds of pages at that time explaining these small differences, but from today's perspective, these differences basically were zero. This is not the case anymore. This is not the case any longer. The US yields are significantly higher than the Eurozone yields, and this difference in recent days and weeks has even increased. And this shows you that capital basically is more productive in the US than in the Eurozone. Apart from risk components. Obviously, you can always invest in risky projects in the US or in the Eurozone, and therefore you get a risk premium, and then see if this risk premium is worth it, if your risks materialize or not. This is something which is on a completely different scale. These are basically risk-free yields, and therefore the risk-free capital in the US gets a higher return than in the Eurozone. This is a very strong signal of the market, because it says that it's more productive to put your capital at work in the US than to put it at work in the Eurozone. And this is also, by the way, for emerging markets, not a very bright message, because everybody is expecting capital to be productive in the US. Also means, well, it's not so much worse taking the risk of investing in emerging markets, which are perceived as more risky. So, especially the fact that in Europe these yields are still around zero means capital in Europe still is not in high demand. Yeah, capital in Europe still You don't have to pay a price to get capital in Europe, apart from the risk premium above this risk-free yield. And therefore, for a risky project, obviously your real yield is not zero, but this is only risk premium. Without risk premium, we stay at zero. And this is not the case for the US, where we are again at 2%, therefore something like the long run pretty scenario growth rates. And this is something which means that it's again a situation where capital in the US can be invested productively, but not so much in Europe. And this also enforces the story of we might see a permanent growth disadvantage of Europe versus the US. Now coming to China. As you heard before, this is highly valuable remarks. We see a situation where, and therefore I don't want to show you basically the same charts again. We skip that one. What we see in China is basically a significant growth deceleration. But this growth deceleration basically is an ongoing process since 2008, 2009, when China was still growing at double-digit growth rates. And we have seen, with some cyclical ups and downs, a continued process of growth deceleration since then. And this is again not a story which surprises economists very much. We had this growth pickup of China, which was remarkable and incredible and a huge achievement beyond anything anybody could have expected before. Per capita GDP, we are talking about per capita GDP before. Per capita GDP in China in the mid-1990s was 10% of what we see in industrialized economies. Now it's 35%. A huge achievement. But obviously this was an achievement which was mainly driven by one story: integration of China into the global markets. This was one big trick, and this one big trick had this huge effect. But one single trick runs out of steam at some point in time. And therefore this deceleration of growth that we are seeing since 2008 is quite a normal process. Look, when I learned economics in the 1990s, late 1980s and 1990s, a lot of economists were believing that at some point in time, because poorer countries grow more quickly than advanced economies, at one point in time everybody will be at the same per capita GDP level. Yeah? When the poorer grow quicker than the richer ones, at some point they will converge to the same level of per capita GDP. This was the story of the growth models that were popular in the 1950s and 60s. And all the differences between poor and rich countries were then explained basically by the colonial policies of that time. And once colonial policies end, we see independence, we might see some early adjustment processes, but in the end, everybody will end up at the same level of wealth. This was the growth models of the 50s and 60s. Meanwhile, we have seen that this was not true, that we see permanent differences in per capita GDP levels, in wealth levels between poor and large countries. The 1980s, for example, were a period where poor countries on average did not grow quicker than rich countries. There was no convergence process in the 80s at all. We saw a big convergence process during the period of globalization. But once this effect abates, there's no reason to believe that poorer countries will end up growing more quickly. And therefore, in the end, there's no reason per se to believe that China will grow more quickly than the rest of the world. I think this growth normalization that we saw when China did not have double-digit growth levels, and then China's growth fell below 8%, and then it fell below 6%, and now was around 5%, is an ongoing process which will lead China's economy at some point to grow as quickly or slowly as the rest of the world. And there's still some way to go. But this will not continue until China's per capita GDP will be 100% of that of the Western industrialized economies. They are now at 35%. They might end up at 40%. They might end up at 42 or 45%. But this trick, this globalization trick that they did with their economy only leads them so far. This is what the growth deceleration of China tells from my point of view. And therefore, I'm not surprised that we saw a quite sluggish rebound from the lockdowns in China. And therefore, I would not be surprised to see something like 4.something% of growth in 2025. This year is a little bit more upward pressure, but this is basically the story. Therefore, this high growth period is fading away in China. This is a normal process. But when I say a normal process, this does not mean that this is an easy process. Because obviously an economy that has built up capacities for growing at 10, 12% and at 8% or 6 or 7% has a lot of capacity if it only grows further at 3, 4, 2%. At that point in time. And therefore this overcapacity problem is something which has huge implications, social ones. We saw China youth unemployment shooting up to 30% before they stopped publishing this number anymore. The housing market, which was built for an economy which gets more wealthy and more rich generation by generation by generation, which will not happen. And therefore, this overcapacity problem, that's obviously something which is concerning your industry very much, is something to stay in place, from my point of view. Sorry, I don't want to give too bad signals here, but this is something I find realistic, and it's it does not help to close your eyes concerning these problems. I think a realistic scenario is that China for a long, long time will have this overcapacity problem. That's what I wanted to tell you. We have some minutes left on my clock. Do you have questions? Do you have remarks? Do you have critique? Do you see it completely differently? What's your point? Yeah.
Make a comment on the global financial assets. I've read that the non-bank financial assets in the world today are around 47%, and the bank assets held by banks are around 39%. And normally speaking, non-bank holders of financial assets want to have a higher interest rate if they lend out their money than banks.
Yeah, sure. I mean, this is certainly something which is driven mainly by regulation. Look at in the past, when I was learning how banking goes, we were in a situation where every bank treasurer at the end of the month had to have zero excess liquidity at the ECB, because excess liquidity at the ECB was something which did not earn us money, and therefore our CEO every end of the month came by the treasurer and was asking, do we have excess liquidity? And where God, he had some significant amount. That was highly problematic at that point in time. And this means that banks had the urgency to give out the money that they had received from their customers. This has changed totally. And banks in the Eurozone, in the US, in the UK, have huge amounts of excess reserves at the central banks, which is something which is basically not productive, but is helping them to finance their government deficits by buying government securities or by keeping the government security levels they are holding at high levels. And this is something which has completely, it has a lot of consequences. if capital is not the restrictive factor of banks, their lending behavior is changing completely. It is not dependent on how much capital do I get to end the ECB holding period at zero, but is only dependent on the equity of these companies, because of these banks, because the equity lending ratios are the ones which are basically restricted by bank regulations. What we are seeing at the moment is a market which is not driven so much by market forces, but by regulation. And therefore, banks' lending behavior is something which is more problematic from a macroeconomist point of view, not because banks are so stupid. Sorry, I'm paid by the banks, but nevertheless, that because this is so much driven by regulatory reasons and by the central banks' behavior regarding their government bond portfolios. So something which is completely administered by central banks and by regulators. Something which makes bank capital, high ratios of bank capital, much more problematic than in the past. Sure, in the past we had stupid banks and we had smart banks, and the stupid banks made mistakes and allocated their capital in a stupid way. But now we have, it's not important if a bank is stupid or wise. Capital allocation by banks is something which is at least at the aggregate level, something which is highly administered. This is the problem I see with the numbers you were raising. Please. You have a microphone, yeah.
I've got the microphone, okay. Well, we always have the overcapacity issue in the steel industry, but we also do have a demand problem at this point of time. So do you think, or would you expect the governments in the US, in the European Union, or worldwide to come up with some infrastructure spending programs to boost the steel demand? Or, I mean, of course, there are inflationary concerns and so on. So what would be your opinion on that?
Yeah, I mean, the point is normally I would say this is zero chance, because if you are in a problem where inflation is too high, for example, in the US, and perhaps even a little bit too high still in the Eurozone, higher demand artificially higher demand by such programs would even make more trouble for the central banks, and therefore you would have two players pulling at different ends of a string. Yeah, the government accelerating the economy, the central bank slowing them down. This only ends in pain, and it's not wise to do that. And the other point, speaking against it, that we have seen so much government spending in the Corona years that governments are highly indebted. This is not a problem for the US. Yeah. If you grow this way, it's not such a big problem to have debt. But for others, obviously, it is. And for parts of the Eurozone, it is. For Japan, obviously, it's a huge problem. And therefore, spending more is something which is a measure which is not realistic in zero growth environment. Sure, if you would have a negative growth rate, if we would have another global crisis like the pandemic, or at a smaller scale, hopefully next time, then we could think of something like that. But in a zero growth environment, I don't think that this is a realistic assumption. Sorry about that one.
Thank you.
In the US, by the way, in the US it might be different, because in the US it very much depends on who will be the next president. And while Mr. Trump might not be a bad signal for US growth, the problem there is that there's this balance between fiscal policy and monetary policy might be skewed more to the fiscal policy side. In the extreme case, you know, in the press they are flirting with rumors that there are plans by a possible new Trump government to decrease the Fed independence and to make them less independent, and this would go then into the other direction. But this would be then again a US-specific story.
continue on the same topic, what would be your advices or suggestion for the 41 producers who are attending the conference? So if the economy is such, this view, which is rather realistic, I agree with you, there is a huge volatility, uncertainty, etc. And the demand, as also you just said, to answer Murat's question, is not likely to pick up. No larger expectations for governmental expenditures and the infrastructure. So what do you tell us for us as producers? What should we do?
At least be cautious with investment, because for investments you will have high capital costs going forward. They might stay high for quite a while. And on the demand side, with the new capacity you're producing with new investment, there is not many good signals. Therefore, what I can say from this perspective is be cautious with investments. Okay, thank you very much, ladies and gentlemen. It was again a big pleasure to be here with you, and thank you for your attention.